Hi, I'm Patrick Weinert, founder of The Money Mission, and I help people like you achieve success with your finances so you can lead a more fulfilling life. In this video, we are going to talk about your long-term financial goals. And by that, I'm referring to those goals that aren't necessarily related to retirement. They could be things like buying a home, purchasing a new car, buying an expensive vacation for your family, even getting a second home or a boat or some luxury item. And what we want to do is address how do we save and invest in a way so that we can maximize our returns and build our wealth and enable us to make these purchases without having to go deeply into debt. So in our last video, we talked a little bit about the three pillars that we base our savings and our investing plan on. And those pillars are, you want to begin with the end in mind. We need to get a clear end state. The second one is we want to invest and obtain our goal with the minimum amount of risk. And then the third is we want to minimize our taxes, because taxes can take a big bite out of our investments if we're not careful. So in our last video, I'll just quickly recap. We talked about those three pillars, and what I reviewed with you is I want to present to you strategies that I learned in my work planning the budget for the United States Marine Corps, and use those strategies in a way that applies to your own personal finances. So what I want to do today is I want to use a very simple example, and we'll use this to show how to apply these pillars to your own personal situation. So we're going to use the example of Corporal Jones. So Corporal Jones is 22 years old, and he's a corporal in the United States Army. He makes about $30,000 a year. And he has decided that he wants to purchase a home probably at some point in the next 10 years. And he estimates that he's going to need about $50,000 for a down payment on a $250,000 home. Now, he, as the military, could use the VA loan, but let's say for this instance, he's unable to use it. Either it's like a fixer-upper, or perhaps they don't take a VA loan. And we can also apply this, obviously, to non-military who maybe don't have the VA loan available to them. So if he estimates that he can save about $250 a month, and he's already got $5,000 in the bank, how much of a return is he going to need over those 10 years in order to get his down payment? Well, a lot of people might say, hey, just put all your money in the stock market and, let it ride. Let it continue growing over time, and then, eventually you'll have it. And that's certainly a strategy, but we want to do this, right? We want to achieve this end state with a minimum amount of risk. And so if Corporal Jones took 60% of his money and he put it in the stock market, and then he took now instead 40% of his money and put it in the bond market, instead of putting all of it in stocks, he's diversifying some, he would be able to make a return of somewhere between 6 and 7% per year on average. The stock market has done about 10% a year on average, and right now the 10-year U.S. government treasury bond yields about 3% a year. So if you average those two out, doing a 60-40 split, he would have somewhere between 6 and 7%, which would get him to his $50,000 down payment, in 10 years. Now, why is this important? This is important because the stock market goes up and down. It's volatile. And if he is caught at a time where the economy's gone into a recession and the stock market maybe's crashed, that could be a problem for him in his plan to buy a house. Whereas if he's put some of his money in bonds, that will help cushion that and potentially could really preserve his wealth during the lean times. Now, how would you save this money? We talk about stocks and we talk about bonds, but how do you actually save this money? The best way to save it are in either, for those investors that don't want to have their hand actively in managing this money, have about 60% of it in this example in a broad-based index fund, a mutual fund or an exchange-traded fund. And an example would be a fund that follows the S&P 500 or the broad world market index of stocks if you want more diversification. And then a bond fund, which would be a broadly diverse bond fund following something like the Barclays Total Bond Index. The best companies that I've found are either Vanguard or Fidelity. And actually Vanguard is probably the least expensive. So if you picked one of those funds and put your money in there, that would be a good plan. Now, how do you minimize taxes while doing this? So in our day and age, we have now at our disposal what's known as an asset-based loan. So you can go to a lender and you can use stocks and bonds and other collateral that you own, other assets that you own, to back a loan. You don't have to sell these investments in order to recoup your money to make your down payment on whatever big purchase you want to make. As a result of that, you've got several things working in your favor here. First, if you've got good credit, you're probably going to get a really low interest rate because you have something backing up that loan. Today, you could probably get a 3 to 3.5% interest rate on a loan with assets backing it. The second thing is you don't have to sell any of your assets. So as a result, you don't have to pay any taxes. Obviously, when you have to sell stocks or bonds, you pay taxes on the gains. But if you don't have to sell them, you don't have to pay taxes. And on top of that, you'd even be able to hang on to your investments and allow them to continue growing. And if they're growing at a 6 to 7% per year, you're going to do much, much better because you're going to be able to capture that spread from a 3% loan. So what I want you to do is think about this. Think about what it is that you're doing with your money and your plan. And in our next video, we're going to talk about finding a good financial advisor. And how do we do that? Please post a question, a comment, share this video with your friends. I really look forward to reading your comments. And until next time, I wish you unlimited success.